Hi everybody, welcome to the Leeb.com video for July 20th, 2010. I'm going to change the pace a little bit today and talk a little about China. The Chinese economy grew 10.3%, that's an annualized rate, in the second quarter, down from the 11.9% mark recorded for the first quarter, but at double digits, it's still easily at the front of the pack among major world economies. China's State Information Center reports that in the second half of this year, export growth may slow down to 16.3% as a result of slowdown in the global recovery. The press is reporting this as a halving of China's export growth rate because the year-on-year improvement for the first half of the year was 35%. But it should be noted that China's exports improved by approximately 30% in the second half of 2009 compared to the first half, so the slower growth rate can be partially attributed to simply having a tougher comparison benchmark. To put it in perspective, compared to the first half of 2010, Chinese exports will still grow by about 12% sequentially, even if the forecast for a slowdown in the year-over-year growth comparison is on target. So that's hardly a terrible figure. It's worth reiterating that for all the talk of Chinese economy slowing down, it will still remain by far the fastest growing major world economy. And many economists think that a more moderate growth pace is better for the well-being of the country in the long run. Indeed, with growth moderating from overheating pace, the Chinese government will find it easier to take a more supportive stance on the economy. Its premier, Wen Jiabao, announced that China should expand domestic demand to create jobs in light of headwinds in the global economy and maintain facilitative policies to ensure favorable conditions for businesses. The loosening of the dollar peg means that China will have the potential for more purchasing power overseas. The government will also invest more in low-income housing, and a number of provinces and cities have already raised the minimum wage by significant amounts. Lending restrictions are expected to be loosened as well. The relaxing of Beijing's recent tightening policies will be good for the Chinese market. Additionally, the Chinese government's renewed emphasis on domestic consumption as growth driver should bode well for commodities especially. Despite prodigious growth in recent years already, the Chinese still have a long way to go to match Americans in per capita consumption, indicating ample room for expansion left. That's it for today. Thank you for watching and join us again soon.